All right, so let's go ahead and get started. So with that, starting off just looking at what is the challenges in getting to what we'd refer to as a modern accounts payable operation. Part of the problem is lack of technologies, and there are lots of good technologies out now, and a lot more. There's been a lot of development in this area and innovation in this area in the last 5-10 years, much more rapidly than what had happened in the prior periods. But a lot of AP departments haven't adopted all these technologies for one reason or another, and we'll talk about some of the reasons why. Consistency of processes is part of the problem that AP deals with all the time, that if you don't have standardization or the standardization is weak in that often things are exceptions to the rules, you're much more likely to have exposure to breakdowns of controls leading to mispayments, duplicate payments, or fraud. And decentralized processing in general encourages an environment of exceptions and as a result leads to higher rates of challenges in these areas because it makes it more likely that controls are going to break down because they're not consistently applied. And if you do implement technologies, it increases the cost of implementing those technologies as well as the training and support burden, which is one reason that I have been consistently an advocate for shared service operations in accounts payable areas for companies of larger sizes that have operations in multiple locations. Let's talk about some of the risks of things that can happen. First off, AP people are going to make mistakes, and even if you hire the best of the best, accounts payable is going to have problems, and there's no amount of money that you can pay to have people become perfect. Mistakes are going to happen. No matter how great your controls are, there's going to be errors. You can put controls in place that will reduce the risks of those errors. And sometimes mistakes are going to be costly. Certainly duplicate payments, missed payments are all examples where dollars can be spent and it can be hard to recover back. And overall, you want to design your department in a way that it's going to minimize the risk and exposure to people making mistakes. And that if you look at sort of the old-fashioned version of this, is that people used to, when invoices got entered in the system, they'd have a buddy system where then somebody else goes in and reviews all the information that they entered to see if it's correct or not. That's not practical in most high-level environments, and I don't recommend it in general because it tends not to be effective. But the more checks and balances you are able to put in place, the reduced risk exposure you have to mistakes. But it is very costly to put in place those kinds of checks and balances. And then the other risk is an exposure point is fraud. And fraud is when someone's really trying to get you to make a mistake, taking advantage of a flaw in your processes in order to personally gain. And, important realizations about fraud is part of it is that it is much more common than people realize. And part of the problem is that it is often unreported. And so the stats around fraud that tend to be not reflective of the entire environment of fraud that's occurring. And part of the challenge there is people don't like to admit when they've been defrauded. Part of the challenge is that also, of course, people don't necessarily know when they've been defrauded. And we're going to talk about some of the different categories of fraud as we go through. We'll talk about vendor fraud, invoice fraud, expense report fraud, check tampering, personal purchases is all different examples. We'll talk about examples of each of these and how you can prevent them. There's a lot of different types of fraud, and we'll be looking at it from two perspectives. One is the angle of somebody from outside the organization attempting to take advantage of weaknesses in your controls in order to get money from you. And the other is we'll look at it internally as well, and we'll do that throughout the course of this because internal fraud is actually a bigger exposure point for most organizations than external fraud because far too often controls are based on an assumption that the employees are going to be honest in all their dealings with the company, which isn't, unfortunately, always the case. So when we talk about AP, the role of AP, at a minimum, is to put in place procedures and controls to reduce the exposure of fraud. So we need to make sure that we have controls in place that reduce the risk of exposure. There's always going to be some risk, but we can reduce that risk and manage that risk. And then, very importantly, to execute on those controls. And that may sound like the same thing, but it's actually not. And it is a very common reality that the controls that are written are not the controls that are actually performed. And far too often I have gone up to, when I've assessed AV departments, and I'll ask people for about how they do their work, and they'll show me, and it's not the same as the procedure. I'll ask them why they're not doing it to the procedure, and they'll either say, oh, nobody does because that's not how we really do the work, or they'll say, I've never seen that procedure before, or they'll say, oh, yeah, I saw that procedure the day I was hired. It's in that dusty manual I have in the back of my desk that I haven't looked at since. So it's very common the execution doesn't match up with what's in writing. Reporting it since found, and this is a big, big challenge, and often, particularly when you deal with internal fraud, this can be very touchy, but fraud is too often unreported, both internally and to authorities. And as a result, it is far more prominent than it should be. And when you consider the implications of that, the fact that it's often unreported, that means that if somebody commits your fraud at your organization, and then they go to work for another company, nothing's going to show up in a background check because they weren't actually charged for anything. So if you dismiss somebody but don't inform the authorities, then there's the reality that that person can just go and get another job, and nobody will know different. And you do see a constant pattern of the same people committing fraud over and over again. And then using external P2P auditors is a great way to do a double check. But better do self-auditing and beat those external auditors to it. You should do external auditing as a backup, but do more auditing first and catching things first. And part of the reason is that catching things early is really essential to recovery if it is a mistake, for example, duplicate payment, or catching and stopping fraud if it is a situation where somebody has done it intentionally. So catching it early makes a big difference. So when you wait for internal auditing or external P2P auditors, and they do it once a year, by that time it may be too late to do anything about it, and you may have continued to pay that person fraudulently over a longer period of time. So we talked about fraud. One thing that I'd like to share that I think is really important is the concept of the fraud triangle. And this gets down to the psychology of what causes an employee in your organization to get involved in committing fraud and taking advantage of one of these weaknesses in your controls. And the fraud triangle speaks to the concept that we have three things that must coexist in order for fraud to occur. One is the idea of rationalization. And this is the idea that somebody thinks that they're the good guy, that they're not the bad guy in their own mind, but they have some justification for their action. And typically when you're dealing with employee-based fraud, this is going to come in the form of somebody who feels that they didn't get the promotion they expected, or they didn't get the raise they expected, and they feel that they deserve. So for some reason they feel that the company owes them, and as a result what they're doing is not a problem. Now the second component of that is opportunity. Opportunity is the idea that nobody really wants to get caught, right? So they see a reasonable chance that they're going to get away with it. And then that is something where they see a weakness and a breakdown in controls. They think they're going to be able to get through, commit this fraud, and no one's going to catch them. And then there's pressure. And pressure is the idea that we feel some type of motivation to do this right now. It typically comes in the form of financial pressure, and it could be gambling debts, health problems, potential upcoming bankruptcy, whatever the case may be, that they have some financial pressure in their lives that's causing them to go ahead and say, I'm going to go ahead and do this now. And with the fraud triangle, the idea is that all three of these must coexist. If somebody sees the opportunity, feels the pressure, but doesn't have rationalization, they won't move forward. If they have rationalization and pressure, but they don't think they're going to get away with it, they don't see the opportunity, they're not going to go forward. So when you look at this, it's a very important part of any discussion about controls, because you can't control the rationalization that people feel. You can't just give them a raise every time they want. You can't control the outside pressures in someone's lives. What you can control is the opportunity. You can make it both very hard for them to get away with it and very obvious to them that it's going to be very hard for them to get away with it. So they don't even make the attempt. Now, when we talk about controls, one of the base things that you always hear people talk about is the concept of segregation of duties. And when you look at segregation duties, really the concept here is we want to divide up responsibilities to reduce the risk of fraud occurring. And the idea of forcing collusion between two parties to commit the fraud, meaning that two people have to work together in order for fraud to occur because we have built walls to prevent one person from being able to do all the things they would need to be able to do to successfully commit that fraud on their own. And while collusion is still possible, collusion is much, much harder. It is very hard to get two people to align in that fraud triangle we talked about at the same time. So as a result, collusion can occur, but it's not as likely to occur. Collusion can also involve somebody inside the organization and outside the organization, and generally segregation of duties can help with that as well. So from a basic standpoint, the idea here is that you've got three basic core responsibilities in AP: adding vendors, entering invoices, processing payments. And so what this slide basically speaks to is the idea that none of these three should ever overlap with the same person at any time. So if they can enter an invoice, they can't add a vendor or process a payment. By restricting somebody to only one of these three, you force that collusion to occur in order for payment to successfully go out the door. So this is a very basic step that every AP department should take. And commonly where you see that broken down actually is with management, and we'll get into that in a second. So here's a quick chart, just very, very simple, in terms of I've been brought in to assess segregation of duties, but the reality of it is that this is something that's not that hard to do on your own. And you table where you have your different tasks that you do within the department, the different roles in the department, and check to see where the overlap exists. And make sure there's no overlap in those core areas that we talked about, as well as you may find other areas where eliminating overlap may be beneficial. But nobody should be able to take that an invoice, enter it in, create the vendor, process the payment without anybody else having the opportunity to check to make sure that it's out. But part of the reality is that a lot of departments deal with, first off, not enough people in AP. If you're a one-person AP department, what I just mentioned sounds really, really like a good idea, but probably not very practical in your environment. The other thing is that even if you had three people in AP, what if one of those people got sick? What do you do? So you need to have backups for each of these roles. A very common area that we see is that managers or directors of a department end up getting access to do all three. This is a common mistake, and I challenge very much the need for that person to do all of those things. And so I'd ask that if you do have a situation, that be one of the things you look at, establishing segregation of duties, because they are, at that point, very much empowered to be able to commit that type of fraud. As possible, you have technology limitations as well, setting up security in your ERP or accounting system. There might be some limitations that come into play. For the most part, though, the systems are pretty good about being able to do this these days. The issue tends to be that either you see exceptions to things like managers or directors, or there's not enough to divide things up. And so where you don't have enough people, I would challenge that a little bit to find a way to make that work. And even in small departments, what I tend to see is maybe somebody, an administrative assistant, ends up maintaining the vendor file, for example, somebody outside the department. There's ways you can get around the controls. Now, in the worst case, if you absolutely are unable to separate out those responsibilities, is you can establish some good, solid reporting and take a responsibility for somebody who's not that person to proactively look at that report on a regular basis. Regular meaning more like daily, weekly, not yearly, to make sure that everything looks on the up and up. And specifically, you can target that to whatever the breakdown in that control and segregation duties is. And that applies across the board with controls. You always can look at things after the fact. You just want to minimize the amount of manual effort required to do that. When we talk about putting controls in place, the concept here is to catch errors or fraud before it's too late and to deter fraud attempts. The challenges often are undocumented. They're inconsistently applied, but it can be time-consuming and, as a result, delay payments. And controls need to balance the need to be effective in catching things with the reality is that you're operating a business and you need to move at the speed of business. So if the controls are getting in the way of your business operating, that's not a good thing either. So that's a very delicate balance, something that we always consider and factor in to how we put controls in place in AP operations. So let's go through our first case of fraud and talk about steps that can be taken to prevent this particular case. So in this case, we have a manager who submitted invoices for a fake company at AP, and they were in the position to be able to approve the invoice. This is a real story. This is a healthcare organization, so a lot of dollars going through the hospital, and this is something that made the papers and quite embarrassing for this organization at the time in their local market, and something that did get reported as a result, but an example, kind of thing that generally companies don't like to have get out in the public. They ended up losing $800,000 over 8 years. And in this case, what was happening was that there was a manager who was responsible to approve invoices up to $5,000 for their department, as long as it was a budgeted line item. So what they did was they took a budgeted line item, a service that they were getting from a vendor. They canceled the service with the vendor, but they kept it in their budget. Then they went out and they created a fake company in a name that was essentially the same name as that vendor, so they could open up a bank account and change the vendor information, call the AP department, change the vendor information to the new bank account information and address, and continue to submit and ultimately approve the invoices for that vendor for many, many, many years. And eventually they were getting away with it, so they couldn't increase the dollar amount because they had a $5,000 approval limit. So what they ended up doing was doing it with another service and another vendor. So eventually got to the point where they had stolen $800,000. In this case, AP was decentralized. The invoice approval was one touch, up to $5,000, and they didn't have the vendor file controls in place that I'm going to share with you in a second here. So when you look at this category of vendor fraud, it talks about a few different areas. One aspect of it is just vendors who are just pure out fake, that don't actually exist as legitimate vendors. That is one example. In other cases, you have situations where it's fake invoices against legitimate vendors. And then you also have changing vendor information such as addresses and ACH banking information. This ACH area is actually a big breakdown in a lot of controls that I see, because more and more people are turning to ACH to reduce check volume. But what a very standard test that I do, and you can go ahead and try this with your own departments, is I call up the AP department, say I'm with one of their vendors, we'll call it ABC Construction, and say I'm with ABC Construction, we've changed bank accounts, can you please change my ACH information? And generally what happens is they say, sure, what's the new bank information? And then they type it into the system. Or they say, here, I'll send you a form, what fax number should I send it to? What email should I send it to? And they send it over, you fill it out, and now that company's bank deposits are now going into your bank. It's actually a remarkably simple scan to do, and this has been done on payroll as well as in accounts payable with direct deposit. So we'll talk a little bit more about that in a minute. And then fake invoices, where you have invoices against a legitimate vendor, but the invoices themselves are fake, which is typically an external fraud. Some controls you can put into place to prevent this. So first off, with new vendors, you may or may not be doing some type of compliance checking. You're supposed to check to make sure they're not on the government terrorist list. You might have compliance checks that are industry specific that you have to do. But you should be doing whatever compliance checks are appropriate for that type of vendor in your industry. And you may catch something there. TIN number checks. There's free capabilities from the IRS to check tax ID numbers. And it's very straightforward to do. And you can check to make sure they're giving you a valid tax ID number, which protects you from tax implications and B notices if you have wrong information. And also gives you an additional check to make sure this is a legitimate vendor. The next ones are ones that I actually am surprised how few people do, but just searching for the vendor online, while it is possible that you are doing business with a vendor with no website, that is increasingly unlikely every day. And that doesn't mean if they don't have a website, that doesn't mean you don't do business with them. It just means you acknowledge that that they don't have a website, and maybe you dig a little bit more into something else to make sure it's legitimate. And then do a Google search, because there's a good chance that there's some type of web presence of a company, even if they don't have a website, a mom and pop business, they probably have some element of web presence, Facebook page, Twitter, reviews on Yelp, and something that would indicate that they're for real. And if they don't have any of that, that's probably a red flag. So all things to check. And is it possible for someone to set up a fake vendor, set up a fake website, get a tax ID number, register with the government. Sure, those are all, none of those things are necessarily hard to do, but each one of these is a barrier that somebody may not have thought about and may lead to you catching them. Verify when you're changing vendor information. There should be somebody that you designate when a new vendor is set up that is the responsible party to change any type of critical information. So that ACH attempt that we made earlier, somebody should be checking to make sure that it's coming from the right person and that the right person's signature is on the paper. And then fake invoice patterns. There's a concept called Benford's Law, which is a way of detecting fake invoice numbers. And the concept there is that if I were to ask you to randomly come up with a number between 1 and 10, if I asked you enough times, your mind would inevitably repeat the same numbers on a consistent basis because we ultimately have subconscious preferences for certain numbers over others, and our brains will go to those numbers. And Benford's Law is a way of detecting that. With enough data, you can catch those types of patterns. So that would apply in certain cases. And there's a movie called The Accountant starring Ben Affleck, which is actually an action movie where they a fraud case with Benford's Law. So if you want to check that out. Controls for invoice approval. That, if you look at this situation we talked about before, invoices should always be matched to a PO or approved upon receipt. That wouldn't have saved this particular case. Invoice approval should always be electronic. That means even if you get invoices with a paper signature on them, you should send them out for approval. If you do not have an electronic workflow system, you can still use email, but I would strongly recommend you have an electronic workflow system, and there's plenty of great solutions for that available these days. If you get a paper invoice, route it anyway. Ideally, invoices should not be one touch. The $5,000 scenario we talked about earlier, what I would recommend if you're going to keep it that high is that you should have auditing of transactions within a particular dollar range to that's just below their approval threshold to make sure that it doesn't seem like there's unusual volume. And if you have to audit for those patterns, but ideally you wouldn't have any type of one-touch approval. And with a good workflow system, there's really not a lot of reason not to have that approval be dual touch, so you have a better chance of being able to catch it. So let's take another case of fraud. This is a case of travel and expense-related fraud. So this is an example of collusion. So in this case, the employee of the company quit the organization, and they made a deal with their manager to continue to submit expense reports. The manager approved those expense reports, and they split the money 50-50. And they did this for 3 years. Increasingly, dollar amounts started off really small. They kept increasing it. So the employee was in the AP system as an available vendor, and so nothing seemed unusual about it. The AP department had paid for this vendor before, and the manager was approving the expense reports. And ultimately, it's pretty common that AP departments don't question an expense report approved by a manager. So the net result is that they were able to get away with this for many years. And there's a total of $55,000 that was taken. So when you look at it, let's talk about how we can prevent something like that from occurring. When you deal with expense report controls, there's a couple of things to think about. There's requiring approval of expense reports. Obviously, that's something you do. Requiring receipts. So I do recommend per diems. There's a whole travel and expense webinar that I do on a fairly frequent basis that's focused on T&E policies. And one of the things I strongly recommend is per diems over actual receipts for meals. It saves a lot of time and money. But for everything else, make sure you get a receipt. And you make, at a minimum, you need to make sure that you bounce the vendor file against the employee file at least once a month to make sure that if an employee's been terminated, that we no longer have a vendor for them. Better is if HR has a notification, particularly better if you have a workflow system, notifies through a workflow of terminations and to use an online T&E system. It's still very common for people to use Excel-based expense reports. There are a lot of great time and expense solutions available for a small amount of money, for just a few bucks per person per month, that would help tremendously because if you inactivate their user ID when they are terminated, they have no way to submit an expense report. And ideally, expense reports should be processed through payroll, not through accounts payable, because first off, payroll is in a better position to be able to determine whether or not that particular expense is a taxable benefit, and also because the payroll always is maintaining direct deposit information anyway. Generally, when I recommend that, AP departments love the idea, payroll departments hate the idea. But it is really, when you step back and think about it, it is the more appropriate place for that responsibility to be. Real fraud case number 3. So let's talk about another example. So in this case, purchasing cards were used for personal expenses. So they stole $125,000 over 2 years. And this was an example. I've used this one in a few different things that I do because it was actually my first exposure to fraud as an adult, working at a company that was a software implementation company. I ran the implementation department. We had purchasing cards for all of the traveling team members on my team. It's about a 50-person company, so it was fairly small. One person did most of the books, and they took care of managing the purchasing card program, which was an American Express program. They issued themselves a American Express card without telling the owners, but the owners probably wouldn't have cared anyway. They trusted her completely. She was a long-term employee, and she ended up using it in line at the grocery store one day, and her credit card got rejected, so she pulled out that credit card and figuring she would just pay it back the next day. Well, she didn't pay it back the next day. As a matter of fact, she realized she got away with it, and then she did it again and again and again and again, increasing dollar amounts till eventually she got to the point that she was taking her family to Disneyland on the company credit card, which is eventually what got her caught. So a lot of elements here are important, that it's a long-term trusted employee, very common, increasing dollar amounts over time, very common, and she was in a position to be able to cover it up and bury the expenses because she was in a position of authority and control in a way that was unchecked. Again, a very common aspect of fraud cases. Some of the purchasing card controls and things you can put in place. First off, that purchasing cards are a very common element of fraud. It's a common area that fraud occurs, and it's one of the most common breakdowns that we see. I love purchasing cards. They're a great tool, but unfortunately, they're often deployed in ways that don't have very good controls in them. You need to have a dedicated purchasing card administrator, though there should be somebody watching them. Somebody who's auditing that responsibility. There should be a written policy, and repercussions, including the potential to be terminated, need to be clearly laid out in that policy. Approval of expenses still exists. You need to have automated controls. A combination of pattern-based audits and random audits. And I'll talk about audits in a couple of capacities. But to put it in context here, that in general, auditing should combine pattern and random. And when you think about this, this is exactly how the IRS operates. The IRS could never possibly look at every single person's tax return. As a matter of fact, they do randomly they pull tax returns, but your chances of being randomly audited by the IRS are less than 0.5% now. They've really cut that back, and they do much more pattern-based auditing, which is basically to say, well, there's certain types of deductions or certain formulas we use that seem out of the norm that lead us to make it more likely that we're going to pull a particular return for an audit. You want to do the exact same thing with every control you put in place in your organization. You want to do some level of just pull something off the shelf and random just in case your patterns fail, and then you want to have a lot of pattern audits that are checking for unusual behavior. What is unusual behavior for you depends on your situation. Maybe it's using these cards on the weekend. Maybe it's using them in the evenings. Maybe it's using them at casinos. There's a lot of great reporting available from the P-card programs that are out there. You have to decide what the parameters are that make it so that you would pay a little bit more attention to one expense report over another. And then it's important to take swift and decisive action whenever you do find something so that people realize that you take it seriously. From a payment controls perspective, a couple of things to think about. Wire transfers, high risk. They should only be done with 100% trusted vendors. People are doing less and less wires. I do see like an increase in things like there's Zelle now, where you can do essentially the same benefits of a wire transfer, where it's instantaneous between banks, and you do it online. I'm not totally sure how the economics work of it on the back end, but it's free and it's available through a lot of the big banks, like Wells Fargo and Bank of America, and many others offer this service. And so it's a great convenience, but important to realize that once the money is transferred, it's gone. You don't have any really good way of getting it back. So just realizing that anything like that should only be done with highly trusted vendors. With ACH, very important to verify that you're changing information for the right reasons based upon the right request. And this is a common breakdown area that I see as people go more to ACH. So I'd really look at, if you do ACH transactions, I would really look at if the vendor's changing that ACH information, how do they go about doing it? How do you know that they're really from the vendor in question? And from a check perspective, this may sound counterproductive, but using microprinters is actually a great control. So the check stock doesn't have anything printed on it. You have to use a microprinter that prints it on it. That's a great control. And printing signatures is actually a better control than manual signatures. And that may sound crazy, but the reality of it is that the banks don't really look at the signatures. And so when you have a signature that's on there, they're not really paying much attention to it. And honestly, it is a whole lot easier to forge a handwritten signature than it is to forge a printed signature. So the printed signature has a specific look and style to it, makes it obvious it was printed. A handwritten signature is much, much easier for someone to forge with little effort. So just something to consider, that these are stronger controls than a lot of people realize in the real world. Now, when we talk about controls, one thing that always comes up is a concept I call fake controls. This is when an organization has controls that they think are impactful and doing something, but in reality are just distracting and taking time away from putting good controls in place, or just wasting people's time. And I mentioned the buddy system earlier, where you pass batches from one person to another to have them check it. That's a great example of what I would define as a fake control, because it tends to be that the buddy is just glossing over it because they're not going to spend all that much time looking at them. It's boring work. So you think that you're double checking everything, but in reality, it's just slowing down the process and not giving a lot of value. And also, protecting that person from just doing the right thing in the first place. I use the Dora the Explorer cartoon here because, so if anybody has kids, the Dora the Explorer, this villain Swiper comes and steals from them, but if they say Swiper, no swiping, then he goes away and doesn't steal from them. Unfortunately, the real world doesn't work like that, where you can count on just telling people not to do something results in them not doing it. So you need to make sure that you have good controls in place. Some examples of fake controls, I mentioned the batch review and the buddy system concept. Requiring original invoices only. These days, in the eras of laser printers, nobody knows if invoices are original or not. So this tends to be something that a lot of policies speak to that doesn't have any implications in reality. Or you spend a lot of time trying to chase down an original invoice and then find out ultimately in many cases there isn't such a thing. That's clearly something that's original. Check matching, taking the invoices, matching them up to the checks, is another example of something that I've eliminated in many AP departments. Having two check signatures, and I should mention the check matching is one that I get debated with a lot, that a lot of people hold on to this, and once they eliminate it, they're so much more productive, so much happier, and they realize in the end this was just enabling other bad processes rather than actually solving a problem. Having two signatures on a check is not really an effective solution. Again, the banks aren't doing great at checking, and it's not hard to forge. And then limiting P-card usage. So putting a good purchasing card program in place is better than limiting the use of purchasing cards. We spent some time talking about fraud, but fraud is not always that good controls can catch. Another example is duplicate payments. And duplicate payment is money out the door that we hopefully will get back, but we may not, because you may have an unscrupulous vendor who may not volunteer that you did it, or you may have a vendor that's no longer in business, or you may have a situation where by the time you find out about it, so much time has expired that that we're in a position where we can't track down and get that money. So your accounting system probably prevents you from putting in a duplicate if three key fields are the same. The organization, company number, the terminology may vary depending on your particular system, a vendor number, and an invoice number. So if these three are the same, usually an accounting system will let you enter in it. Basic control that most accounting systems have. But a duplicate can be created if any of those numbers are different. So if an invoice is entered in the wrong vendor, for example, it's going to allow it to be entered. So if you have two vendors that are the same, basically duplicate vendor, much better chance you're going to have a duplicate invoice. And if the invoice number is typed incorrectly due to inconsistency with naming standards or standards don't exist, then you can have a duplicate entry. And that's the common scenario where you see that somebody enters an invoice number 1234, the system flags it as duplicate, and this happens more often than most people care to admit. But what happens is that the AP processor, who often is measured based upon how many invoices they enter into the day, doesn't want to spend the time researching it, so they put a star on the end, and now it's invoice number 1234 star and goes into the system. And we've created a duplicate. That is shockingly common. So when we look at duplicate payments, importantly, the other aspect of it to think about is that for a duplicate to be entered, there has to be an attempt to enter the invoice twice. So why is that important? Well, not only do they have to enter it in by mistake by going around one of the controls or by making an error, but also we have to have the invoice twice in the first place. And this is why you tend to see high rates of duplicates in environments where there is a heavy backlog in accounts payable. Because vendors send the invoice again because they didn't get paid, or they might call the question or fax the invoice, or you might look something up and not find it in the system because it's not entered in yet. And the result of any of those things is that someone's going to ask the vendor to send another copy of the invoice. Now you have an opportunity for a duplicate to be created. And that can happen over and over and over again if you're paying slow. So environments where payments are not made on time intentionally or unintentionally because of slow processing in AP, slow approvals, anything that's slowing down that process, creates a much higher risk of duplicate payments occurring. In the end, no matter how many duplicate vendors you have and no matter how bad your people are about entering the invoices in with the stars and other ways to get it in the system, if the vendor doesn't send you the invoice twice, you're not going to enter it in twice. So where you have high-risk environments is where there's multiple versions of each vendor. You have centralized and decentralized invoice receipt because there's two places the vendor can send the invoice. I see this all the time that a shared service center, if the invoice is stuck in processing somewhere, the vendor calls the local office, sends them a copy of the invoice, they forward it on to AP, and in the process create a duplicate. If you don't use purchase orders consistently, you have problems because an invoice could not be matched to a PO, which might mean that when the invoice comes in again, that PO is still open and we're able to match it again. And then lack of invoice entry standards. If you don't have good documented standards that, again, are executed upon about how an invoice gets entered in, then you have a high risk of duplicate payments. And the best example of that most people can understand is something like utility invoice. So you get in a utility invoice, there's no invoice number. Somebody has to enter in the invoice number, and so they make it up, and they'll do something like account number -D. And when they do that, what if one person enters them with slashes in between the date fields? One person puts a dash and then a space, and another person doesn't. All those things that can create duplicates in your system and lead to duplicate payments. And then also you have situations like bleeding zeros. Some people will drop them, some people won't. Dashes and other characters that if there's an INV at the beginning of an invoice number, do you enter it? Those kinds of things have to be documented and consistently applied across your AP department or you're creating a higher risk of duplicates. So things you can do to prevent the duplicates, first off, limiting duplicate vendors is absolutely essential because duplicate vendors is one of these leading causes. So if you don't have a good process to prevent duplicates from being entered, then that's something to look at. And that means you need strong naming standards about how vendors are created so that it's not because someone just didn't look it up right. And you also need to make sure that only one or two, or depending on the size of your organization, people have access to that vendor file, so it's a highly controlled environment, and those standards are regularly applied. And you have to cleanse for duplicates on a regular basis because no matter what, you're probably going to get some duplicates. And then having a written invoice numbering policy, talk about things like special characters and utilities like we talked about. Self-auditing, making sure you're auditing before payments go out the door and after, and then using third-party auditors is a great way to catch things that you don't catch. Typically, third-party auditors in procure-to-pay are going to work off a percentage of what they recover, which makes it all the more important that you attempt to recover things on your own. As an AP leader, it can be costly and embarrassing to have a third-party auditor catch a lot of things. But that's not a reason not to do it. It's a reason to make sure you're taking the steps to catch the low-hanging fruit, the easy stuff first. so they're less likely to find things, and what they do find will help you to drive future process improvement as you design your plans for your future. And then ideally, there's a category of software called continuous compliance monitoring software that I think is in its early stages. I think there'll be a lot more of this coming in the future, where they do automated checks for things like duplicate payments on a daily basis, running queries in the background to try to catch for common behaviors. And then that information gets presented on a dashboard for someone to review. Typically, these systems produce a tremendous number of false positives, and that's one of the reasons that people see it as a negative. But looking at those false positives will allow you to catch the positives along the way and to refine the formulas to eliminate the number of false positives in the future. So this is a highly evolving category that I think will have tremendous possibilities in the future. Some of the controls, interesting things that they do that are hard to do manually, things like the address checking, the vendor-employee file bounce, so they can bounce against your employee file on a daily basis. Check for addresses, but you can do that again yourself in Google. Things like prisons, I think it's interesting. Wouldn't you want to know if one of your vendors operates out of a prison? Maybe you're buying license plates and that's okay. You're not concerned about that. But if you didn't know that, that's probably something that bears some investigation. Looking for patterns and looking for duplicates. These are examples. I think this is an area that will get more sophisticated over time. I think it's also an area that the ERP and accounting solutions need to do a much better job of. And I hope that they rise to the occasion over the course of the next decade. Ask yourself, some things to ask yourself, kind of tying up some of this. Has your organization been the victim of fraud? Have you been? And if so, think about why that occurred and steps you can take to prevent it. Do you have one-touch approval on your invoices? That's an area as well that if you do, that you should either eliminate that, ideally, or put in good, solid controls to make sure that nobody's abusing that privilege. How do you approve and process your expenses? When was the last time you cleaned up your vendor file? And how many people have access to your vendor file? Just examples of things you should be asking yourself as a result of attending this today, as well as I'm sure many other takeaways that hopefully you were able to get out of this. So with that, I think I'm just at time. So for us to ask questions, I'd like to encourage everyone to ask questions about anything that we covered.